Good afternoon, everyone. Welcome to today's Wednesday market review. My name is Stock Darts, and we're going to do what we always do on Wednesdays. We're going to go ahead and take a look at the four major market indices: the S&P 500, the Nasdaq Composite, the Dow Jones, and the Russell 2000. Once we finish looking at those, we'll take a quick look at the U.S. dollar. We'll see how it's affecting oil, gold, silver, and the cryptocurrencies like Bitcoin and Ethereum. Then we'll move on to chart requests. If anyone in here has a chart request, feel free to type it into the chat. I'd be more than happy to go ahead and take a look at your chart once we finish analyzing the markets. If you like what you see here, if you're watching this as a recording, you can always find me on Twitter under the name Stock Darts. You can find videos like this under the same thing on Stock Darts on YouTube. Or you can visit me at patreon.com/StockDarts, where I post weekly blog content including trade ideas, particularly the types of trades that I'm looking to take, as well as a quick analysis of what kind of environment we're in, which is really what we do these Wednesday market reviews for in the beginning, is we want to analyze what kind of market environment we're in, and then from there I go ahead and try to tailor my trade strategies to match that, and that's what you'll find at patreon.com/StockDarts. Other than that, let's go ahead and get started. First thing we're going to do is take a look at the S&P 500 through the ETF SPY. As you can see, we are right back to where we were just a week and a half, 2 weeks ago. And that is right at this important inflection point, which we've been kind of stuck at since the end of May, really, and definitely throughout most of June. And that is dealing with all-time highs. We had an FOMC statement last week. I wasn't able to do a Wednesday market stream last week, but that Wednesday was an FOMC day. And the market did not react well to it, and we actually had quite a bit of a sell-off that day or that afternoon, and it was followed by a little bit of selling on Thursday. But then Friday we had a pretty big gap down. As you can see, I'm going to zoom in a little bit. You can see down here, this was the Friday candle, and it was a pretty big move. We dropped right below the 20, right below the 50, and it looked like the market had kind of given up on looking for new highs and had rolled over. However, that was met by very strong buying to start this week. As you can see, on Monday we had a huge candle, basically taking the price action right through the 50 and up into the 20, and then yesterday we broke right through the 20, and today we're kind of stuck right back in neutral because we're right back to this ceiling that we just can't break through. The market is trying desperately to break to new highs, but it's really struggling to do this. However, we've had a very interesting turn of events this week, which is capital rotating back into the Nasdaq and kind of away from the Dow and from IWM. And we'll see that as we move forward and we take a look at where the money's rotating in and out of. But we had a little bit of a sector rotation this week, with the tech sector sort of taking the mantle of leadership again and trying to be the area of the market that takes us to new highs. And to a certain extent, it has been successful. At least as far as the Nasdaq is concerned, but we're still waiting to see exactly how this is going to play out. How this is going to play out with the other indices as they try to follow suit. And so, we'll see exactly how the market goes ahead and tries to follow through and see whether the S&P 500 tries to go through and break to new highs as well. But what we're going to do right now is just take a look at the SPY ETF in a vacuum, and then we'll kind of move on from there. And you'll see when we get to the Nasdaq that we are indeed at new highs on the Qs, although we're not seeing it yet with the other indices. So as far as the S&P 500 is concerned, overall this is still a pretty bullish chart. As you can see, the farther we've scaled back, you can see we've been in a very strong uptrend for a pretty good point of time now. Basically since last year, when we headed into the holidays, we kicked off a new rally, and we've had two really decent bouts of consolidation or range-bound price action, with the one that we're in right now being, I guess, the longest or the most substantial one. You can see if we draw a rectangle, you can see that we've basically used every little inch of real estate we can to remain within this channel and still be trading in a sideways range. Right, give me 1 second. me just, we'll get back in a second. All right. Sorry about that. Okay, so as you can see, we've used every single bit of real estate that we have possible to trade sideways while still staying within this channel. But we are reaching a point where something's going to have to give. We're either going to break out or we're going to break down. There's going to be a certain point where there's just nowhere else for the price action to go. As you can see, now granted, this channel or this trend line isn't 100% significant because in reality it's not really touching anything throughout a good portion of this. It's really just almost an intersection of these trend lines here. But what it's really doing is it's following the 50-day moving average. And so either way, we are coming to a head where we're going to have to come up with the price, the bulls and the bears, or the buyers, sellers, however you want to conceptualize it. There's going to be something that's going to have to happen here. We're either going to have enough demand to break through the supply that we have here at highs, or there's going to be too much supply and we're not going to have the demand to kind of meet it, and we're going to break down and break through. And so we're reaching a point right now where, and it's an inflection point that we've kind of been stuck at for a while now, where we just can't break through these highs, but we're reaching a spot where something's going to give. We're either going to break out and start a new rally, or we're going to roll over and we're going to start correcting a little bit more and heading back and backfilling some support areas and see exactly where the buyers are going to be willing to support it if they can't support it up here. Now, as I mentioned earlier, if you look at the NASDAQ, it looks like we're breaking out. But if you look at the Dow Jones, it looks like we're breaking down. And like I said, we'll get into those in a second. But we're getting pretty mixed signals. So we're not really sure exactly what's going to happen yet with the S&P 500. Now, my expectation has been for a while now that we're transitioning into a market that's going to be sideways, which means that I don't expect a full-fledged breakout here, and I don't expect us to really break out and rally much further than where we are right now, but I could be wrong. And so one thing I always try to hammer home here during these market streams is that we are, as a trader, we aren't really in the market, or we're not really, our job isn't really to predict the market or predict equities. It might seem that way, right? When you look at it, you ask anyone if they trade stocks, the first thing you think of is, well, they must be good at predicting where the stock is going to move, and that's not really the case. Obviously, you're going to make predictions. You're in the business of trying to figure out what's going to happen in the future. But in reality, the key to really being a successful trader is to react to what the market does rather than to try to guess what the market does. And so, even though I've been kind of guessing that the market is going to transition to sideways, and part of the reason that I've been so cautious over the last couple of months is because I don't expect us to really break out full-fledged. However, that has not really changed the actual trades I'm taking. I'm still taking bullish trades, and I'm still looking for moves with upside, because that's what the market has given us for so long. And until it does something different, we're just going to go ahead and play that way. So even though I think that there's probably a higher chance that we roll over here, I'm still going to wait and see what the market does. I'm not going to just try to short the market here. I still think that we're in too strong of a bull market to even really think about shorting to begin with. And so when we have these kinds of scenarios where I see a market that's probably range bound or probably needs to correct, rather than thinking to myself, well, I want to short this, I have two modes of behavior. One is to wait. If we break out, then I play the breakout. Two, if we roll over, then I wait to buy the dip as we come down and retest support, because I think that there's going to be enough buying demand still waiting here as we test lower levels of support that are going to give us better buying opportunities and better buy the dip plays than what a possible short play would give us when you look at this market that's been very, very choppy. There have been a couple scenarios where we sold off, but it's been a 2 or 3 day sell-off, and it's immediately met with buying demand and with a bounce. And so, we're still at a spot here where we're getting muddy waters. We have two different currents that are pretty strong, that are kind of colliding. One is the strong current of bullish sentiment, and the other is this pretty growing current of bearish sentiment or of supply that is just kind of really clogging up the area, not allowing this bullish flow to kind of push through it. And so what happens when these two meet, you get this muddy water and you get the chopping back and forth as the two currents collide and just kind of go back and forth and swirl around until we see where exactly they clear up and which direction they're going to go in the future. And so that's where we are right now, and that's why it's been difficult for those of you that are traders, particularly those that are swing trading directionally, have probably had a difficult time over the last month and a half or so. And that's because of the type of environment that we've been in. We've been in a very conflicted market environment, and those types of environments are not conducive to easy swing trading. And really that's the kind of the issue we've had, and that's part of why I've been pretty disciplined. For those of you that follow me on Patreon, you'll know that we've been looking at trades, maybe a couple trades a week, but we're looking at scenarios that probably won't pan out. But if they do, then they'll make easy trades for us. And what I mean by that is, I'll look at a stock and I'll draw these trend lines and I'll say, well, I'm not going to buy this unless it breaks this trend line, understanding that there's a pretty good chance it won't break that trend line. And if it doesn't, then I don't even get into the trade. But if it does break that trend line, then it shows the strength that we need for us to trust it a little bit more in this kind of environment, and then we can go ahead and try to take it to the long side. And I'll give an example of a couple of those ideas. Actually, I can do it right now. Oops. So one trade is this one, rail, right? And you can see what we were looking for. We wanted it to break this trend line, and if it didn't break the trend line, we weren't going to enter. But if it did break the trend line, then we could go ahead and enter. And that's exactly what it did. It's not doing fantastic at the moment. It's still struggling with its moving averages. But this is the kind of idea of what we're looking for. MUDS is another one that you can see yesterday. It had a very strong breakout through that trend line. But it's the same idea where I'm looking at something that's probably not going to work, but if it does work, then it should give us a decent move. An example of a couple that didn't work and why we didn't take them would be something like maybe True Corporation. Well, actually, no, this one did work. It actually did break out pretty good once we were able to get, I think it was Trivago. See, so Trivago is one where we were watching it last week, or actually a week and a half ago, and what we wanted was for a break of this trend line. And if it did, you can see what was happening here. It's very similar to what we're seeing in the S&P 500, where you have this convergence of technical indicators. And if it did break out from there, then we would have gotten a move very similar to True, which was this was actually another one that I had that week. And it took a while for this thing to work, but it finally did start working over the last 3 days. But Trivago is one that we were kind of waiting for, but we knew that there was a pretty strong chance it was going to break down. And if it did break down, then the likelihood of it succeeding goes down, but we don't even enter the trade. We wouldn't enter the trade unless it broke that trend line. And so we just kind of wait, and if it works, it works. If it doesn't, then we move on. And so those are styles of trades that I've been kind of focusing on because we have a market that's not giving us clean moves. So what we have to do is wait and kind of force a stock to prove itself before we go ahead and trust it with an entry and a potential trading opportunity. All right, so going back to the S&P 500 here, as you can see, it's in a similar place, right, where we are getting these two trend lines that are converging. The moving averages, everything's converging into this one spot here, right around 420 to 422, and we're going to have a decisive move either up above it or down below it. And so if we break out above, we're at all-time highs. There's no real resistance we could point out to that's not just theoretical. However, we break down, and if we break below the 20 and the 50 in this trend line, well, then we're going to probably have a quick move down to about 411, and then probably head even further south down to about 404 to 402. And at that point, we would hope that the bulls can kind of support the price action before we get down to 397. Once we start going below 400 and into these 397, 398 area, that's when we start to challenge an important zone, which was the last kind of volatile consolidation range that we had earlier this year. And, we're bound to trade sideways. We're bound to pull back. what you don't want is to go backwards. You don't want to start going back through ranges that you already kind of developed enough potential to go through. Um, the market often goes in cycles where you accumulate, then you either mark up or mark down, and then you accumulate or or distribution. And when you have these little ranges of accumulation, you don't want to go back and through them. You want to keep going and kind of breaking forward and not coming back and backfilling through those. You want to backfill through these surges upwards because that's what you want to retest. Is that there's enough demand to kind of meet the markup phase that came after the last accumulation round. And so that's kind of what we want to see here as far as where we want to backtrack to. And like I said, if we do break out, the big key is that if we do break out, we don't come back and fall below 423 and make this a false breakout. And that'll be the big issue is not necessarily how high up it goes, but when it does pull back, does it stay above this green line? And if it does, that's very bullish, and we should get much easier trades for the whatever period of time we rally. Alright, so here's the NASDAQ. As you can see, we've broken out. We've actually broken out a few days in a row now. We actually started last week right after that FOMC day. So, there has been rotation back into tech, and it actually has done pretty decently. And as you can see, the NASDAQ is under the impression that we're done consolidating and we're ready to rally. Now, there is a kind of an interesting thing here, which I pointed out before, and that is that the NASDAQ has already been trading sideways for a while. If you notice, we broke that uptrend a while ago. Unlike the S&P 500 has kind of stayed in its range, the NASDAQ actually already kind of corrected and has traded sideways for a good amount of time, right? Since basically the middle of February up to now, it's been kind of consolidating, and it only now is starting to break out. And so it's looking like maybe it's been leading the way all this time, and it's ready to kind of move past this consolidation range. And if so, maybe the S&P 500 and the Dow still need to rotate sideways before they're ready to follow the NASDAQ up. And if that's the case, then I wouldn't expect very strong price action upwards from the NASDAQ, more just along the lines of it kind of inching upwards and maybe building a new range above it. However, if the NASDAQ rallies strongly, and there is potential for that, because if we start looking at some of these FANG stocks, they're starting to do better, but they haven't entered real full-fledged rally mode either. You can see Facebook has been slowly kind of making its way upwards, but it's been trading sideways for a while. If you take a look at it, for most of May and June, it's been trading in a pretty tight range, and before that it was actually kind of correcting before it started to really rally towards the beginning or middle of May. And so there's still a potential for it to break out and push past that. And if we go ahead and take a look at the other FANG stocks like Amazon, you can see Amazon still hasn't actually really pushed through its highs. It's still really trading sideways. So if you go ahead and take a look at a long-term look at Amazon, you can see it's still very, very much range-bound and still dealing with a potential ceiling coming up. Apple also still very much in a range-bound state. Now, it has actually done very good for us. This was a trade that we looked at. And again, this illustrates exactly the types of trades that I like to take during these types of environments. Apple was at another one of those inflection points, just like I explained before with some of these other stocks that I looked at, where it was right at the point where it was either going to break down or it was going to break this sort of downtrend and start making its way back up to the top of its range. And as you can see, it eventually materialized with a nice trading signal for us to the upside, and it's been slowly making its way right back to the top of this range. And so you can see that there's still potential. If the markets are going to rally, there's potential for Apple to continue to make its way back up and start to challenge highs. There's still plenty of upside here. However, like Amazon, this is really just a range-bound stock. You can see it's been range-bound for a while, and it's just coming up to test its ceiling. So if we are going to rally, we're going to need to see these FANG stocks really kind of push the envelope and start to really start to rally through these areas. You can see Netflix actually has a gap that it still needs to, it's still trying to challenge the bottom of that gap, let alone try to fill it. So this has been one of the weaker ones, which is expected when we consider the rotation patterns that we've been seeing this year as money rotates away from some tech names into more recovery names. And then finally we have Google, which actually has been one of the leaders as far as the FANG stocks is concerned, and has been slowly making its way up. But like the overall markets, it's really started to slow down as it challenges all-time highs. You can see the manner of the price action. While it has been kind of pushing forward, it hasn't had any kind of real explosive move because it's been just really dealing with the potential distribution areas upstairs. All right, so looking at those, you get a better idea of what the FANG or what the NASDAQ is doing and what it's trying to do. However, like I said, if you look at the four indices, this is the one that's really starting to really try to rally. The moving averages are starting to align themselves in a way that might make sense for us to continue rallying. The 20 started to cross back above the 50. I don't think they're right at that alignment yet that really kind of tells us we're 100% going to rally. If you take a look at the way this works, we're right about here, where there's a good chance that they start to curl upwards and start to kind of support price action up. But we could still be at a spot where they're just going to do another one of these kind of crosses before they really do it. You can see the last time that happened, we had a cross, but the market wasn't really ready for it, so it just kind of went through. And so it could be that we need another one of those, or it could be that we start to see them curl up more. If we start to see the 20 curl up, of course that'll be in response to further upside on the Qs, but that'll give us a little bit more confidence that this trend could start to really develop, and we could start to see a rally coming. Now, looking at the key levels here, how are we going to navigate this if it does pull back or if it does break out? So if it keeps kind of running up, the key is, of course, same as the S&P 500. We've had a breakout. We don't want to give this breakout back. Like I said, you don't want to go backwards. So we want to hold above this green line, and we want to hold above the previous level of resistance. If we do fail there, then I don't think that really bodes well for the markets as far as rallying is concerned. And I think it means that we're going to have to sort of consolidate further and definitely trade more sideways. And if that's the case, then we're going to probably lose the 20-day moving average and come back and test the 50. With the strength that we're starting to see on the Qs, it might be that we just need to test the 50, but if we head lower, we've got support down here around 330, and then the real key area is going to be about 324, 325, which, like I said, you don't want to go backwards. You don't want to fall back into the previous range, and that means we want to stay above this area here. All right, if we look at the Dow, totally different picture. We've kind of rolled over. We were never really able to break above our highs, and you can see the moving averages are starting to kind of curl over. We're finally losing this channel, this very narrow channel that has kind of supported price action since November, and you can see we've been trading sideways, and this is the exact opposite of what we're seeing with the Qs. We're seeing a market that is rolling over. There's no other word for it. You can see we failed at the highs. We failed a little bit short of the highs. We've cut through the moving averages. We broke below the channel, and now we're coming up and we're trying to get back into the channel. We're at a pretty key inflection point again, where we either fail here and then fully fall out of that channel, or we rally through the moving averages and take another shot at these highs. If I was just looking at the Dow in a vacuum, I would say that we're going to roll over. When you look at what the S&P and the NASDAQ are doing, there's the hope that if they rally, the Dow Jones kind of gains a little bit more, it gets a little spark, and tries to kind of bust right through and make its way back up. It could be that we're just going to be more sideways, in which case we start to see again sporadic price action where certain areas of the market do better than others. Maybe we see the Dow kind of pull back more while the NASDAQ rallies. If that's the case, like I said, I wouldn't expect a very strong NASDAQ rally, but it could still rally. And if that's the case, then we'll see what the Dow Jones does. Now, if we're looking at this, like I said, just as in a vacuum, you see the 20 start to get closer to the 50, start to roll over. This is showing momentum fading, right? And we're starting to lose it, and we're starting to turn to the downside. Um, if we fall back below this trend line, it's going to be a quick shot down to 332. And more likely than not, we probably lose that and start to explore somewhere in here around the 320s. I don't think we make it all the way to the 200-day moving average, not unless all unless all the indices break down together. If this is just isolated to the Dow, it could be that we just find support around 330, 332, 330, maybe the higher 320s, and then we kind of try to make our way back up and start chopping through the moving averages and do something similar to what the NASDAQ did when it lost its channel, right? And it kind of broke. You can see the same thing. We broke down, tried to get back in, failed, had a further breakdown, but it eventually held up, and it held up above the 200-day moving average, and then eventually resolved into more sideways price action. It could be that the Dow Jones is finally following suit and doing the same sort of thing. And if that's the case, I'd expect, like I said, a drop down somewhere into this area where we find support, we consolidate for a while, and then try to make our way back up. And I'd expect it to basically follow the pattern of the NASDAQ if the indices do their own thing. If all of them correct together, then we might make it all the way back to the 200-day moving average. But if the Dow Jones is correcting while the S&P 500 and the NASDAQ hold up, then it likely just kind of consolidates in space here. So that's going to be an important thing to kind of watch, is how these indices move together. If we're seeing two of them move up and two of them move down, then we shouldn't expect really bad downside. If all of them move together, then we should expect more downside or more upside if they all actually rally together. All right, and then small caps is the last one. This is an interesting picture as well, right? Because we've got, like the NASDAQ, IWM has actually already been trading sideways. They've already kind of been struggling. They built up nice momentum last week to kind of try to break through. And then we had the FOMC, and you can see we kind of pulled back. Big volume spike. Now, we've bounced just like all the other indices. We bounced this week. But you can see it's not quite the same strength as what we saw in the NASDAQ and even on the S&P 500. We're still chopping through moving averages. Now, they are starting to spread out, and the 20's starting to climb up. This could be the beginning of IWM catching up to the NASDAQ and doing the same pattern and breaking to new highs. We'll see what happens as we close out this week and whether we can see an acceleration here. But you know, just like the NASDAQ, IWM's a little bit ahead of the curve. They've already traded sideways. They've already consolidated after that rally that we had last year and the start of this year. So they're closer to rallying than really what the Dow Jones is. And the S&P 500 actually is holding pretty good when you consider that it really hasn't kind of broken this uptrend. But IWM had actually already traded sideways for a while. And it could be more ready for a rally than maybe the S&P 500, although we're not really seeing that yet. If that's the case, we'll see more catch-up, and we'll see it kind of come up and break through these highs. So this is going to be important for the small caps, is, of course, break through this 234 area. And if it could do so, then it could maybe follow the NASDAQ up. Now, if it falls back below these moving averages, then that's probably not as negative maybe as what we would see with the Dow Jones breaking down from where it is now. It could just mean that it needs these moving averages to curl more or coil more. But if it does break through the 50 and back below 220, then we maybe have to head back down here. Now, I don't expect to move back into the 211, 210, 209 area unless all the indices move together. Like I said when we were looking at the Dow Jones, where there are these scenarios where either the indices all break down together, break out together or do the thing separately. If they all correct together, then I would expect IWM to lose 220 pretty quickly and to head back towards this area around the 215, 210 area. If all of the indices break out together, then IWM should obviously make its way back up to highs and probably through them. Now, if you have the Dow Jones pull back and you have the NASDAQ break out, well, then IWM is probably going to just kind of meander aimlessly until it's ready to kind of follow one or the other. And if that's the case, then I would not expect a breakout to work, but I would also not expect a breakdown to head back towards these lows. I'd expect it to stay around the moving averages. And so that's the four major market indices. As you can see, there's a little bit of mixed signals going on right now between the four indices. We have a couple of them looking strong, a couple of them looking, or one of them looking weak, and then one of them looking kind of really not sure what it wants to do. More often than not, when you have that, it leads to more choppy price action. And so there's a pretty good chance that we'll see the NASDAQ try to break out and really not do a good job of it, and Dow Jones break down and not do a good job of it. And so until we see them all moving more strongly together, we can assume that, again, it's going to be choppier price action. And we need to focus on controlling our risk and trying to find where money is rotating. Those that are nimble probably would have noticed that money was rotating back into the tech sector last week, and should have been better poised for some of these bounces than maybe someone else that isn't paying attention to these capital inflows and outflows through different areas of the market. All right, so now that we know what the markets are doing, let's take a look at the U.S. dollar. You can see the U.S. dollar. This is part of the reason that we're starting to get kind of erratic price action, as the U.S. dollar is finally starting to do stuff. Big breakout on FOMC day with the threat of rates going up, which of course would bode well for the U.S. dollar. Explosion upwards, up right back to the top of this range. It wasn't able to really break out from there. It broke, it kind of pulled back a bit. But this is a big change in character for the U.S. dollar. This explosion upwards. This is something that we've been anticipating and something that we've been watching. Those of you that are regulars here on Wednesdays, you know that we've been waiting for this turnaround, and it was really already developing prior to the FOMC statement. I would probably expect this to be a shallow pullback, and I'd expect the UUP index to make another challenge at this 25 area, and then see whether it has enough strength to really break out and put more damage on some of these other currencies. If we take a look at the currency crosses like the Euro US dollar, now again, this is going to be inverse. You can see the Euro broke down pretty significantly when the US dollar broke out. And that's going to happen, of course, when you have two currencies going against each other like that. And so the US dollar rallied very strongly, which of course put a lot of pressure on the euro. And here's the little correction. But we're coming up. We didn't even test the 200-day. If the US dollar is going to keep its strength, it's going to push right back through this level again and challenge this 118. And then we'll see whether it's really ready. You can see the euro has actually been trading in a pretty range-bound area versus manner versus the U.S. dollar. And if we lose this 119 on the euro, then it might have to come all the way back down to 117. So keep an eye on that as the U.S. dollar puts and exerts more pressure on the euro. If you look at the U.S. versus the yen, again, you can see the dollar rallying. Now, again, this is something we've been watching. It's been pretty clear. Nice little channel developing as it kind of makes its way. It's up to highs. So we'll see whether it has enough momentum to really break through that, or if it's going to falter here. But looking pretty good. And then the last one, and this is the very interesting one, is the U.S. Canadian. You can see the U.S. finally putting some pressure versus the Canadian dollar. This is another one that we've been watching, knowing that this is probably going to happen. Now, the big key here is that it's actually rallying even as oil continues to kind of hold up. You can see oil has been slowly inching its way upwards. Now, oil, I imagine, is going to get tired soon, and it's going to pull back. It's going to pull back maybe to 70, maybe down to 66. When it does so, I'd expect the U.S. Canadian to really start to pick up more steam. So if you're a forex trader, you're someone that actually likes to trade these currency crosses, keep your eye out for the U.S. Canadian, because I think there's a pretty decent chance that we're going to get a move here from the 123, 122 area back up through 125 and 126, and maybe even all the way up to 127. If oil breaks down, it'll happen pretty quickly. Now, oil might not break down. Oil might keep chugging along, and if it does so, then that trade's going to be a little bit trickier to handle. But that's something that maybe you want to watch if you're a forex trader. And that's one way that I avoid the tricky parts of the market. For those that maybe are watching this and haven't followed me very much, I'm a big advocate of trading different types of vehicles, not just the stock market, but I like trading options, I like trading futures, I like trading forex pairs, and I like trading cryptocurrencies. And the reason I like trading all of them is if you can read a chart, you should be able to trade most of them, with the exception, of course, being options, where you need to have a little bit more knowledge of how options work and how you want to use them. But as far as trading cryptocurrencies, forex pairs, futures, or just stocks, they all trade off of chart patterns, right? And what I found is a lot of times when the market's not cooperating and not giving me good trading ideas, it could be that I have much better trading opportunities with cryptocurrencies or with forex pairs. And I think right now we've had pretty easy trades with forex pairs, while the cryptocurrency market has corrected very sharply, and the U.S. market, the U.S. equities or stock market, has been kind of stuck in neutral and really giving us difficult trading opportunities. And so it's important to branch out and to try to broaden your horizons a bit and learn how to trade some of these other vehicles, because they could give you really good trades when other areas of the market or other areas of trading are not. And so, like I said, oil, you can see we got a little shooting star today. If it pulls back, if it loses this 20-day moving average, I would expect to see a pretty strong move out of the U.S. Canadian. And then finally, the last commodities we're going to look at is gold and silver. As you can see, pretty severe breakdown with the rally in the U.S. dollar. Those of you that follow me regularly know that I've not been really a fan of trading gold and silver recently. It was starting to perk up, and I felt like there was some good opportunities starting to develop here. And this could still be the case. If the U.S. dollar falls back down, and if this ends up being just a blip in the radar, then gold and silver should be able to kind of recover. But as you can see, GLD is right back into this long-term downtrend. So it needs to get back above about 170 or so. You can see a shooting star today. Overall, this is not a good picture, right? To have this kind of a big breakdown, it would need to get back above here, and we need to see the dollar break down in order for me to kind of trust this. And it's going to be the same picture with SLV. You can see a big gap down and a move right back to the 200-day moving average. We have today's candle started off bullish, but it hasn't really materialized beyond that. You can see we've got a little bit of a, not really a shooting star, but inverted hammer, and it needs to kind of build off of this and start to make its way back up. But it's going to be difficult climbing if the U.S. dollar continues to show the strength that's starting to develop in it. So, like always, I'm not going to be touching silver or gold anytime soon. And then finally, we have Bitcoin and Ethereum, which have also had some pretty big moves. You can see, again, Bitcoin dropped pretty significantly last week, and actually over the weekend. You can see with the big move down on Friday, or actually not Friday, on Monday. It found support, but we had a pretty big drop down into the 28s. I would say this looks like a potential bottom, and it looks like this could be a staging point for a good rally coming in cryptocurrencies. However, just like the stock market, we are at a pretty good inflection point, and there's a pretty good chance that this rolls right back down. And if it does, then we're probably going to, have significant downside and we'll see where it ends up. But it'll likely come back and challenge the 30s and get well below them, back into the 28s and possibly further down. Uh, if it can get back above this area, get above its moving averages, it could kind of maybe stabilize and start making its way back up towards its recent ceiling, uh, around 40, maybe get back above it. But just like the stock market, we're at a pretty big inflection point here where Bitcoin could roll over and take everything with it. And what I mean by everything is all the cryptocurrencies. You can see Ethereum doing the same thing, where it had a very good floor around 2150 that it was kind of holding off on. And we had a breakdown on Monday. And now it's just kind of holding up at these wicks. But again, we've got strong momentum to the downside. And there's a chance that this this could accelerate even further, especially with the volatility you see in cryptocurrencies. If you're someone that has missed out on Bitcoin and Ethereum, particularly on Ethereum, this is not a bad spot to look at maybe starting to scale in. If it can break this downtrend in particular, get back on this side of it. With the understanding, though, that if it does roll right back over, it could be heading down to about the 1500 area, at which point it would be another good opportunity to add more and get a pretty good discount on some of these cryptocurrencies. However, like I said, at the moment, it's always a good thing when you're looking long term. You want to buy the blood, right? You want to buy when people are just kind of flooding out of it. But you have to understand that when you do that, there's a chance that you're early, and it continues to the downside, which is why you want to scale in. But we are seeing some pretty good discounts here that we haven't seen in a while, and there's a chance that we could be seeing even further discounts depending on what happens next. So the U.S. dollar, like I said, is exerting a lot of pressure across the board. And if it continues to do so, we might see even further red across the board, leading to more difficult trading circumstances in most equities. All right, so I think that covers it for today. If anyone has a chart request, feel free to type it in. If not, we can go ahead and wrap it up. As you no doubt have noticed, I'm kind of stuffed up today. I have some kind of sinus infection. So I think we've kind of had enough here. So let me know if you have a stock that you want me to look at. If you're watching this as a recording, you've made it all the way through the end. Thank you. I appreciate it. You can always message me on Twitter. I'd be more than happy to look at a stock for you along that lines, and post your chart request through Twitter. All right. Well, it looks like it's it for today then. Have a good rest of this week, and we'll meet again next Wednesday.